Welcome back to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth online. Of course, as always, ZinniaWealth.com, ZINNIA Wealth.com. If you've been listening over the last couple of weeks, you know that we've been spending some time talking about a local issue that you in Marion County will see on the ballot, and that is the 1% sales tax, the half-penny sales tax, and that will be right there on your ballot. Of course, everybody's going there for other reasons as well, and that, of course, is to vote for president. So what we thought we would do today is take some time to look at simply the retirement issues. What are the presidential candidates talking about when it comes to the things that affect us on this show? And they would be taxes, Social Security, Medicare, the stock market, and the national debt, the things that we talk about that affect Charisse and you as you plan for your retirement. So we're not here to take a side. We're here basically to say, this is what this candidate says about Social Security. This is what this candidate says. How does that all play out? How does it affect you? So we're going to start here, Charisse, by talking about taxes. So the Trump Tax Cuts and Jobs Act was it started in 2017. So you've been dealing with this for the last 6-7 years. It is set to sunset on January 1st of 2026. If Trump is elected, he says it will continue. If Harris is elected, it will likely come to an end. So let's just bite that part off right now and say, let's take that. As you've been helping people plan for retirement over the last 6 years, has the Tax Cuts and Jobs Act been a good thing? Has it not really mattered? Tell me the pros and cons that you have had with planning over the last 7 years.
Yeah. So for the average individual whom we work with, those pre-retirees and retirees, it is a different kind of planning. We have been lucky because the standard deduction for most people, or a lot of people out there, has been much higher than having to itemize taxes. So the Tax Cuts and Jobs Act that, Congress, Republicans and Democrats came together in 2017 and they agreed, hey, for the next 10 years, we're going to raise your standard deduction, which gave more people a higher write-off on their income. And after 10 years, as long as it didn't cost them more than $1.5 trillion, and then after 10 years, it cost them nothing, then they will revert those taxes back to where we were in 2017, which is January 1st, 2026. We don't know where we're going to stand, but right now it is set to take those deductions, the $29,200. If you're married filing jointly, you get $29,200. That's going to get cut in half if everything stays the same. So if Donald Trump gets picked as the president, his goal is to keep that standard deduction, which has helped a lot of people. And a lot of our tax strategies that we've built into our plans, it's been a huge benefit because people are having to pay less taxes on the average. Now, if Harris comes in, of course, they're going to do other things and revert back, and it's going to cost us more in taxes. But there's other benefits that will come part of that as well. So for the tax changes, it's going to be a whole different kind of planning if Harris wins. And a lot of people, Randy, will go back to itemizing. And I know a lot of you were so happy when you didn't have to itemize your taxes and do that long form anymore. Because, for example, let's say you're writing off the interest on your home that you owned and you had a little side business. You write this off and this off. A lot of households were not writing off $29,200. So now what you're going to find yourself going back to is going back to probably something like that. So is it good? Is it bad? Is it indifferent? Anytime I think an individual pays more taxes, and if it does go back to where it was in 2017, Randy, the average individual is going to be paying $1,000, $2,000, maybe $4,000 more in taxes. That's money that can go back into the community, go back into prosperity and shopping and getting things back on Wall Street straight. So again, I'm a fan of not going back to the old ways and really moving forward, to be honest.
So let me ask you about the whole idea of itemizing. There's things that we talk about here on the show that I, in my mind, think that that's going to be a tax situation. You talk about end of the year tax loss harvesting. We also talk about doing charitable deductions. All of these things would be things that would show up on our taxes. If someone is not itemizing, are they eligible for some of the things that we talk about here on the show?
those people who are not itemizing and you're taking that standard deduction, there's things called above the line deductions.
Okay.
So if you have an IRA or 401k and you're 70 and a half, you can do this thing called a qualified charitable distribution. Instead of writing checks out of your checkbook and paying and donating to your churches and to your charities from accounts that you've already paid taxes on, if you're 70 and a half, it's quite the benefit what they have going on right now, because they allow you to gift through this qualified charitable distribution, if you're 70 and a half, those IRA dollars. So you don't have to pay taxes on those, and neither do the churches or the charities. So right now, that's a huge benefit. I don't know how much that's going to change here in 2026 still, to be honest, but it's been a glorious thing. Almost all of our clients use that resource, and they're saving a ton of money in taxes by doing that. The other thing is the donor advisor funds. There's really neat strategies there for donor advisor funds to get other write-offs, et cetera. Because I think the goal here, Randy, is when you're getting ready to retire, and even if you're in retirement, how do we get to a lower tax bracket in the future? Because we've been told, hey, when you retire, you're in a lower tax bracket. But really, 7 out of 10 people, they're in the same tax bracket or a higher tax bracket. So our job as a fiduciary and a retirement planner is, number one, it's just not your investments and your income plan. It is that tax strategy. And our tax software and our strategies today, we're going to have to make some changes in the future to tighten down those bolts even more if we do go back to the 2017 taxes.
Well, one of the things that we talk about regularly here on the show is to have a financial advisor in your life who's paying attention to taxes, to have a CPA, to have somebody on your side that you're working with in the tax area is extremely important, because Charisse, just in the last, 10 years, 11 years that you and I have been doing this show, there's been the Secure Act 1, there's been Secure Act 2. It used to be that you could stretch an IRA over your entire lifetime, that it was inherited to you. You could stretch that money out. Now they've changed the rules that you have to empty that account in 10 years. I've heard other people say they'll probably change that to 5 years. There are a lot of changes that are taking place within the tax realm that we have to keep track of, and you have to keep track of, because you're regularly meeting with your clients and say, hey, they changed the rules. We've got to change our plan.
Yeah. And we get a lot of people, Randy, that are coming in and saying, hey, if Harris wins, corporate taxes are going to go up to 28%. And if Trump wins, it's going to go down to 20%. And right now it's at 21%. And what people don't understand is that if corporate taxes do go up, we still pay for it in the long run. These companies will pass that burden to us as consumers, and all of our products will continue to shrink, or we'll pay more for them. So I call it the PPP, policy person position. Vote policy and what works for your personal economy. My personal economy says, hey, let's keep taxes the same so our clients can get more write-offs on average, and keep those corporate taxes down so that we don't get hurt in the back end anyways, and therefore earnings look better, companies are thriving, Wall Street and the stock market is growing.
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. We're today taking a look at some of the election issues, the retirement issues that are related to the candidates and the elections. And as a candidate comes out there and says, hey, I want to do this, or I want to propose this, or here's a problem, here's how I'll solve it, any good journalist would say, okay, how are you going to pay for it? And if you talk to Trump, he'll say, we'll pay for it with tariffs. If you talk to Harris, she'll say, we're going to make people pay their fair share. We're going to tax people of higher income. Let's talk about that for just a few minutes here. And the Biden-Harris camp has always said, for those people who are making less than $400,000 a year, no change. For people who are making more, you will have to take on more of a tax burden. So talk to me about that a little bit, because I know that you have a very wide variety of people that come in, people that might come in with $5 or $10 million saved for retirement, other people that might come in with $500,000 saved for retirement. It'll affect people in different ways.
It really will. So the average American, it's not going to affect you that much. It really is not. But the people who really are driven to get income based on your investment portfolio is going to be a little bit of a pain point. And then on top of of it. If your income is over $400,000, it's even worse. But I'll be honest with you, even right now, Randy, if your income and your married filing jointly is over $133,000, you don't get to use the normal tax bracket like everybody else. You get to use that awesome AMT tax where you're paying 26 to 28% on your dollars, right? So right now, people who do have higher incomes, it's not favorable anyways. But people who do hit over that 400,000, it looks like, it'd be a bigger dent. And some people say, hey, well, that's not fair. I've done well, blah, blah, blah. But I really think it's a matter of fact, Randy, because, the individual that only saved 500,000 or $1 million, they've done well too, right? Mm-hmm. And so I'm always a believer, believe it or not, that I'm okay paying a little bit more taxes because I do make a little bit more money. So why not pour it back into our community? I'm here to serve. But there is a number where I'm just like, okay, that's a little too much now. Like really? Like then I wouldn't say it's not fair. I'll just say, is there a medium number here, right? And I feel like we're at that medium number right now. I can handle the AMT right now at 26 and 28. But if it were to go to 33 and 36, I might get a little upset personally, right? And along with other people, not crying the blues over here, but we all work hard and we all have our own lives and we live in our own silos. So saving every dollar is important, but also helping the entitlement programs stay alive because we don't want retirees having to go back to work because they get cut. To me, is a huge part and a big part of the initiative for Republicans and Democrats.
Currently, the corporate tax level is 21% for corporations. Harris wants to raise that to 28%. Trump wants to lower that to 20%. Let's talk about just that right now because you are a business owner.
Yeah. So I'll start with Harris. Democrats typically advocate for a higher corporate tax, and Harris would likely support raising the corporate tax rate from the current level to potentially 28%, right, from where it stands today. The argument is that increased corporate taxes could provide more government revenue to fund Social Security, Medicare, and other programs for retirees, right, and just people in general. But high corporate taxes might also reduce corporate profits, right? We talked about that earlier, which could impact stock prices and retirees who are invested in the stock market and their 401ks and their IRAs and your pensions. You'll probably see a slower growth of your portfolios as companies face higher tax burdens. And on top of that, they're going to pass the risk off to you anyways because costs of goods are going to go up. So let's talk. And then that leads to, potential inflation, right? And we've already had shrink inflation. If you've seen the recent Snicker bar, it's like half the size. I have to buy 2 for the same price to get my original 1, right? And it's a positive and there's also negatives. Every campaign, it doesn't matter if it's a Democrat or a Republican. There's always a pro and con to each one. And we just got to pick what we personally feel is best for us. And this is what I love about voting. We get the choice. As long as you do your homework and you understand how it's going to affect you and you really dig in, I think that helps people really figure out, okay, is it person or policy I want to vote for? And right now it's all about policy and how can it help us get out of debt? How can it leave more money in the consumers' pockets? How does it keep moving the stock market up without, hyperinflation? So there's a lot of concern there. So that's Harris's take, right? Trump would likely continue advocating for lower corporate taxes and maintaining the current status, right? And what that does is it brings higher earnings to the companies. It makes Wall Street happier. And if you have investment portfolios and you live on those investments, it just helps all together with capital gains. It helps all together with the markets moving forward and the growth of your portfolio. And it's going to affect everybody, right? Whether they raise corporate taxes or they don't raise corporate taxes and lower them, because somehow, some way, somewhere else in the program, in this campaign, things have to be paid for, right? But there's other things that we can shift to and make changes to. You know what I like, Randy? I like to stay in the middle because maybe corporate taxes could go up 1% or 2, and Harris wants to do that, but she wants it to go to 28, which I think is a little too steep. And this is my opinion, by the way. And then Trump says, no, I want to take from 21% and bring it down to 20. And I'm just like, I don't know if that's necessary, but I'm happy with a 22% or 23%, somewhere that would make all people happy. And it's not going one way too far or the other way. And we're still all helping each other. Like, where is that person in all this? Like, do I need to run for election, Randy? I mean, I like to make common sense of it. If I was running, I'd be like, well, they say this and our party always says this, I'm going going to go right in the middle. I might not get elected, right? I'm too fair.
Let's talk about this whole how we're going to pay for it thing. Trump has said he wants to eliminate the taxes on Social Security for seniors. He wants to eliminate taxes on tips, eliminate taxes on overtime, eliminate taxes on if you buy a car, the interest that you would be able to be deductible, that kind of thing. So then you have to say, where is this all going to come from? You're saying lower taxes, lower taxes, lower taxes, but where is the extra money going to come from? He will always say tariffs. So what is your thought on tariffs? He wants to do stiffer tariffs on Chinese imports. I have heard a lot of things that say tariffs don't work. Tariffs will cause inflation. Tariffs will hurt our economy. Your thought?
Okay, so I have a few views of tariffs. So let me kind of give you some positive notes on tariffs. So the one thing I do like about tariffs is that it protects jobs, domestic jobs, right? And it also brings new players to the table. Like instead of bringing these imports in, maybe a company here locally will just start making those products. So it brings prosperity, and it protects our jobs instead of bringing those imports in. Basically, for them to bring their stuff in that they're making in Taiwan or wherever they're making it, it's going to cost them some points to do business with America. But tariffs can also hurt because these other countries are going to say, well, fine, we're going to do the same thing to you. And so what good does it do us if that's the case? So I am pro tariffs, but I'm also cautious about the double-edged sword when it comes to these tariffs for sure. Now, how can they really hurt us? Well, higher consumer prices, right?
Which is inflation, which is what we've been fighting.
Right. So I'm certain inflation will go up. So we're trying to keep it down, right? We got it down. And then there's also the disruption of the stock market. I would have to see a well-oiled plan for me to be like, yeah, tariffs, Trump, yeah, I think it's a great idea. I think it's a good idea. I just think it needs to be done right, and it needs to have a method to it. And, you have to have some respect in all this, right?
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Today, looking at some of the retirement issues that will be on the ballot as you go out and vote in just a matter of days. One of the other issues about taxes is the capital gains tax. Currently, the top rate is 20%. Former President Trump proposes that the capital gains tax will be of 15%. Harris proposes a 28% capital gains cap and an additional 5% for people who make over $1 million. So capital gains, when Warren Buffett talks about this, he says, look, I pay 15%. My secretary pays much more. I'm a billionaire. She's not. Why is that fair? He brings up a very good point that people of great wealth receive their income in a different way, and that way is taxed lower. Harris says, let's make it fair. Pay your fair share. Move that number up. She thinks you should move it up to 28%. Talk to me about capital gains.
I do worry about this capital gains rate changing. I'll be honest. I actually like it where it's at. So even though we like it where it's at, doesn't mean it should stay there because we have trillions of dollars in debt. Somebody's got to pay the piper, and it's obviously going to be us, or the government slows down spending, which we all know that's a joke. That's not going to happen. So the only other way to really do it is raise revenue. The one thing that Harris has brought to the table is that 28%, it's high, right? But the one thing I don't like is the additional 5% for people earning over $1 million. I'm not a fan of that. And the one thing I'm good with what Trump is proposing, 15% is a good number. Long-term capital gains right now are 20 and as the max, but a lot of people are at 15%. So I don't know. I just think that raising that capital gains tax too fast is going to leave a bad message to the Americans that, hey, we've saved, we've been working hard, and now you're going to nearly double our capital gains. I think people are going to be very angry about that. Me personally, yes, I'm going to be angry. And again, why not like a happy medium, Randy? Right now, the highest capital gains that you pay is 20%. And if Harris wants to raise it to 28%, why don't we do 25, nix at 28, and get rid of the additional 5%? Like, is it really going to move the needle at the end of the day? And I think every little piece helps, but I'm still in point in question when it comes to that. So again, I like to stay in the middle. I think lowering the capital gains, the highest capital gains rate, I'm not sure that's the best idea either, Trump. To be honest, yes, I love it. That's a great deal for me and a lot of people. But if we're trying to keep more money in for the revenue and to lower our debt and to prosper, there's got to be that in between. So I really like how things are right now, believe it or not.
All right. You're listening to Retirement Coffee Talk with Charisse Rivers, talking through some of the retirement issues that will be on the ballot as you vote for president. Let's move our way into Social Security. President Trump says, he's always said, I want to protect Medicare and protect Social Security. Yet there's only very, very few lines about that within his platform. It would be very good for retirees, as he says, he wants to eliminate the taxes on Social Security for seniors. Yet, we need to know this, that there's about $1.35 trillion that comes in to Social Security every year. That's from our paychecks. The taxation on Social Security brings in about $51 billion. So therefore, if he takes that out, that's money that goes into that trust fund. And that trust fund is going to run out in 2033. If he eliminates the taxes on Social Security, it could empty that trust fund quicker. That could be a real downside here.
I know. Like, listeners, you guys are all listening. It's like, do we or don't we, right?
Yeah. Because
I have said for years, I wish the retirees didn't have to pay up to 85% on their Social Security in taxes, right? Some people are at 50%, some people are at 0, but it's a hefty tax. And I always wish it went away. Or I wish they would give a retiree credit. Now, pay the tax, keep the rules the same, but based on age and, if somebody's passed away or not, now you're living on a single income and retirement, give a credit. I mean, that to me is a no-brainer. I came up with that the other day and I went, a credit would be amazing. That would just help soften the blow when income goes down, because you lose a Social Security check when somebody's passed away, maybe even part of a pension. So I really don't think the answer is getting rid of this Social Security tax. Okay. I do love the idea of lowering it and changing the rules within, so that, because we do need that revenue, but I would like to take some of those pain points off the retirees, just depending how they're invested. And, I could come up with probably a really good plan here. So I think just taking the tax away completely from Social Security could hurt us, because the goal is that if you're retiring or you're in retirement now, if we do that, that will be a crippling effect to the Social Security Trust Fund being solvent here in 2033 and to be able to still give you your checks.
All right. Now, Harris's thoughts on Social Security are she wants to continue to support Social Security and Medicare the way they are, but move taxes up to continue to fund those programs. And who pays those taxes? Again, the people who are making more than $400,000 a year. People under that threshold would not see any kind of increase.
Right. So for the average retiree, this doesn't hurt them, because they're not making over $400,000 a year when they're retired. And over $250,000 a year is not likely, right? So for the retiree, I don't think this is a big deal. People who are saving money in their 401ks and making money, that's going to be a pain point for us people who are making those types of income streams, right? Your attorneys, the professors, business owners, you name it. Yeah, it's going to hurt. But if I had to choose between the two evils, I would say let's protect Social Security. Let's protect the retiree who is not going back to get a job, who does not deserve to go back and get a job, who health-wise might not be able to go back to get a job, and then to work at age 65. I mean, come on, that's not justified, and that's not the American way. So if we keep the tax reform where it is on Social Security today, and we keep it the same, doesn't go down, it doesn't go up, then yes, then I have to side a little bit on Harris's side. I hate to say it out loud here, but I'm going to, because I am personally willing to pay a little bit more in taxes to make sure Social Security survives. And because my clients and my family are counting on that one stool of income, and if it goes away, or if it goes down, if your Social Security checks go down 20%, you have to have an average of $1 million to $2 million saved somewhere else to get those dollars back into your monthly, billfold. And so I trying to stay in the middle. I'm not going to stay in the middle here. I'm okay with people who have incomes over $400,000 to pay a little bit more. Not a whole lot more, but definitely a little bit more. Here's my final thoughts, because I know we got to shorten this up. Stay focused on your long-term plans. Political changes are temporary, and your retirement plan should be built around weathering the market when it goes up and down, period. Remember, policy is important, and you get to choose. It's your choice. It's your one time to stand up and be like, you know what? I'm going this direction, but just understand policy is the only thing we always ask, and go out and vote. If your vote is all about protecting your moms and your dads and your grandmas and grandpas, that's a great reason to vote, because this could really put a dent in their financial future. So at least if you're not going to do it for you, do it for them, because I know you want to. Thank you so much for tuning in. Live by design and not by default, and we'll see you here next week.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Charisse Rivers is an investment advisor representative of Zinnia Wealth Advisory, LLC, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Charisse Rivers is licensed in your state, please contact their office. Zinnia Wealth Advisory, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency, and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client. They are not meant to imply or suggest you will experience the same results. By contacting us, you may be provided with information about insurance and annuity products offered through Charisse Rivers, NPN Insurance License Number 8718011.